Good afternoon. Welcome to the TheoTRADE afternoon video. Today is September 26, 2024, and we're going to talk about the best bet may be in basic materials. And today we're seeing that justification with the massive gap up, close higher. Basic materials has a tendency to run in ranges. You can see that it runs up, it pulls back, it runs higher, it runs lower, and it has a propensity to be in these, swings that are somewhere around 5% up, 5% down. Well, from this most recent low, we've already run more than 10% and cleared the highs with the gap up, close higher. If you look at the volumes, we've actually got higher volumes on these up days, and we're pushing higher on basic materials. You'll also note that the monkey bars for the week that we like to talk about traded from lower end to upper end, lower end to upper end, lower end to upper end. We've now broken through the third range as far as the weekly distributions. Theoretically, we should or could see basic materials in the last trading day, meaning today and tomorrow, could go an additional $1 to $3. And I say $1 to $3 because we're already kind of through this high. And the range is a total of $3, so we'll call it 99.66. And that would be the next or fourth distribution higher. Now, I believe this basic materials rally higher and move higher is more about commodity prices and inflation. We've used this inflation indicator before. GLD is an inflation hedge versus bonds, so the risk-free premium being bonds and GLD being gold as an inflation hedge. You can see that we have pushed even to a new record high as we're looking at inflation data. So all the way up here, we pushed up to this ratio of 2.51. You can see at the very peak back through here, we had a 2.50. So this is the highest inflation distribution of the highest price ratio of an inflation hedge in the markets. So even though the Fed keeps saying that they have inflation under control and they justified that 50 basis point cut, I would say this move in gold prices versus the bonds and this move in the breakout in commodity prices and basic materials clearing these highs are telling us that the most core products, whether we're talking about chemicals, Dow Chemical, DuPont, glass like Ball, Corning, or we're talking about gold, copper, silver, and any of the basic materials and basic metals, we are seeing a continuation higher, and the numbers are not lying. We see a breakout and record highs as far as that price ratio is concerned. And that is, of course, ahead of what is considered the strongest indicator of inflation, which is core PCE price index. As you can see, analysts are pricing in a 0.2% forecasted rate. Now, that 0.2, if you extrapolate it and say all forward months, because last month and this month there was 0.2%, that would infer that we're at a 2.4% inflation number. That's oversimplification, because we know that oil prices have fallen down, and that does reduce cost of transportation, warehouse, and even plastics, and even the cost of maintenance. But core PCE is the one that the Fed apparently leans on more than any other indicator as far as inflation is concerned. If this number comes in any hotter, and I believe because of the numbers we're seeing in gold data and copper today, copper up more than 3.5% in a single day, then that is likely going to give us an indication that they are not done fighting inflation, and maybe that the 50 basis points was too much. And Brandon and I will discuss that tomorrow. And I think we can further confirm that that is the case, that the dollar's purchasing power is continuing to weaken as we see these lower highs and lower lows, and that rate decision of 50 basis points has continued to dampen and hurt the US dollar. Now, 2 days ago we had the lowest close. Last week we had the lowest price for the year. But this rejection of the monkey bars pushing back to fair price tells me we could easily get back to 100 on the dollar index, showing further dollar weakness against this basket of currencies. If inflation remains high and we don't see a complete collapse of demand, these are the companies that are in the materials sector. You see there's Sherwin-Williams, DuPont, Dow Chemical, Mosaic up here, FCX, Freeport-McMoRan, Newmont Mining, Nucor Mining. And so mining companies, metals and mining companies, packaging companies, and the ones I'm focusing on are these ones. Starting out with DuPont, to me, we broke out of the price pattern back here at about 84. We created this rising wedge or rising triangle, or I don't know what pattern you want to call it, but either way, we cleared the highs, and we're expecting it to move from about 78 to about 85. Therefore, we're looking for about a $7 move, and we're almost all the way there. So I don't want to chase this one on the bigger price pattern. You could try to do a one candle pullback as part of a gap up close higher and still see that move likely getting up to 91.92. But it feels like it's a little bit past where I want to get into the trade. Dow, however, feels a little bit more discounted. And if we're going to break through with what we're doing today, this could be the close above the previous closes and even the trade above this high. Now, is this going to be a V-type reversal? It's kind of a wide V, but even still, that would be looking for 50 to 55, and I'm looking for a 10% rally in Dow Chemical. If we were to take a look at FCX, Freeport-McMoRan, FCX is gold and copper. You can see the gap up close higher pushed all the way up to multi-month highs. It created a double bottom and has already gone full target, so we're not going to chase this one, but it is interesting to see that we've gapped up, pushing through these highs. And if we're really seeing all this demand in the core basic materials, metals and mining, and chemical companies, then we are likely to see that show signs of growth and expansion, or at least demand and preparation for that. And we will likely see growth and expansion in manufacturing countries like China. And China has already created higher highs, higher lows. It's gotten way away from us at this point with these higher highs, higher lows, the breakout. But you can see we've gone from 25 to 31. Over 25% recovery and growth in FXI in a matter of 2 weeks. So the Chinese large cap and the rally and the demand in copper, metals, mining, etc. are definitely showing us that there is some indication or hints that inflation or demand are in play here. The fact that copper is climbing tells us there's probably some demand in there, and we've rallied back up to the previous resistance level as well. The last thing I want to look at in conjunction with this is EEM, emerging markets, and we'll talk more about this tomorrow morning as well. Emerging markets created this massive expansion area, then created higher highs and higher lows. At this moment on that bounce, you would have had higher highs, higher lows after an expansion, and there's a great opportunity to be able to get into the trade at 42.40. Now, we've returned back all the way to these previous highs, and if I look at the chart from a longer time period, so you can see it is this pattern of this slope, we are likely getting to that same slope right here. So if I can get a pullback of about $253 off of that high, we could get back into the trade maybe near 44, 44.50, maybe near the previous breakout, and then be looking at to a move up to 50. So I would take this previous pattern, previous trend, and look for it to establish somewhere in here. Now again, we marked it off of that and those candles, so let's go off of the gap. Still the same slope, we're just going to measure it off of this gap. So if EEM, now that we've looked at the 3-year, we go back to the daily. If EEM fails here, look for a bounce back down to 44.78, and I'd be looking to go into these emerging markets, which would include Brazil and some other the manufacturing countries as well. As long as we see basic materials, commodity prices, and China hold up, EEM is likely to hold up as well, and the U.S. is likely to struggle more. So be careful with consumer discretionary spending, but be definitely paying attention to China, emerging markets, basic materials. We'll discuss what this means in conjunction with the PCE numbers tomorrow, as I believe the reason why we don't think we have much inflation is almost exclusively because of crude prices. So if we go look at crude price and we see the crude prices continuing to fall while we are seeing the move higher in other commodity prices, all of this is putting the pressure on to a low demand in the U.S. from energy, an artificial sense that inflation is under control because crude is out of the picture as far as inflating while everything is going up. This could be your warning, and again, could be the follow through to some confirmation of stagflation. The only reason why I'm leaning a little bit away from the conversation of stagflation is because copper has shown some growth, and that's where we're getting a little bit of disconnect. But I do not believe that we really have inflation under control as the Fed would like us to believe. That's going to do it for me today. Join us tomorrow morning. We'll go, like I said, into more detail about what's going on with China, inflation, and some new targets that we might want to look at. Otherwise, have a fantastic